$1.7 trillion pulled $5 trillion erased from the markets, and for the first time in 80 years, America just got hit right in the heart of its economy by its closest ally, April 2025, while Washington was still tweaking domestic stimulus packages. Tokyo struck. $1.7 trillion in U.S. Treasuries, once called strategic gold, was dumped in just 48 hours. No press conference, no negotiation, just one line of data. Quietly updated on Bloomberg that morning, Wall Street stared at the screen, then bled. It was the largest capital pullout in U.S.-Japan history, and it proved one thing. Financial loyalty doesn't last forever. No bombs dropped, just one bond dump, and Wall Street went up in flames. Dow Jones lost 4,800 points. NASDAQ dropped 12%. S&P 500 fell to its worst level since the 2008 crisis. Panic spread faster than any recovery tool. $5 trillion in U.S. market cap. Evaporated bond yields on the 10-year Treasury shot up to 6%. 2% homebuyers crushed businesses, squeezed credit cards, suffocating. According to Fidelity, 47 million retirement accounts hit major pension funds, lost 15 to 20%. In just 3 weeks, personal assets collapsed. Market trust snapped, the middle-class dream torn into shreds. Wall Street didn't need a war. It just needed confidence to vanish, and the collapse began after dumping $1. $7 trillion in treasuries. Japan didn't run home. They pivoted and attacked with capital. $300 billion into Chinese and Indian bonds, $200 billion into Southeast Asian infrastructure reserves in yuan and rupee, up 40%. USD holdings slashed from 54% to 35%. This wasn't a tantrum. It was a chess move. Years in the making, and no, the US wasn't blindsided. Japan had warned, stop taxing our EVs, stop manipulating the yen, stop treating us like the junior partner. Washington didn't listen. So Tokyo pulled the plug. No threats, no sanctions, just stopped buying US debt and started investing elsewhere. The result? America lost its buyer, its leverage, its seat at the head of the table, China. Not a chance. They've slashed their US bond holdings from $1.1 trillion to under $800 billion in 5 years. Europe too busy saving itself. The Middle East, now trading oil in yuan when Japan walked away. America realized no one else is standing behind them, and the system began to crack piece by piece. No trade war, no press release, no post on truth. Social Asia didn't declare a dollar exit. They just flipped the switch in private meetings. Japan, China, South Korea, and ASEAN launched a new financial network. No ideology, just numbers. $1.2 trillion in regional currency swaps. Cross-border trade. No more USD. Bilateral deals settled in local currencies by the end of Q. 162% of Japan, China trade ditched the dollar-yen, and yuan surged in global payment systems. No speeches, no drama. They just stopped using it. And when the majority stops, the dollar becomes the one left behind. No weapons, no shouting. Just trust quietly moving elsewhere, and the old system collapsing on its own. At the G20 summit, one piece of paper was handed around, thin as rice paper, but heavier than any sanction ever written. A proposal, a new global reserve basket. And no, the dollar wasn't invited. No more exclusive control, no more Fed setting global rates. The new basket: gold, energy, defense, tech, Asian, European sovereign bonds. According to the IMF, USD's share of global reserves dropped to 52.0%, 7%, the lowest in nearly 30 years. Yuan and yen rose faster than at any point since their global recognition. No one's turning their back on America. The world is simply choosing a new path, one where they don't need permission to use their own money. This isn't a collapse, it's a shift change. The dollar wasn't defeated, it was simply moved aside. While Americans are paying more for Japanese cars, is Japan preparing a financial blow that could shake the US economy? US-Japan auto trade war. The US has continuously raised tariffs on automobile parts imported from Japan, particularly in the electric vehicle industry. A 25% tariff on auto parts has driven up the prices of Toyota, Honda, and Nissan cars in the US, causing these models to lose their major competitive edge advantage in the market. According to the latest report from the Japan Automobile Manufacturers Association, Japanese car sales in the US have dropped by about 7% in the first quarter of 2025. Meanwhile, U.S. automakers such as Ford and General Motors are attracting more customers due to government protection policies. This price increase not only reduces consumers' purchasing power, but also harms Japanese automakers as profits sharply decline and production costs rise. Japan responds beyond words. However, Japan is not just responding with tough rhetoric. In fact, it has started selling off a large portion of the U.S. Treasury bonds it holds. Japan is currently the second largest creditor to the U.S., with over $1 trillion. $1 trillion in bonds in February 2025, Japan sold $30 billion worth of U.S. bonds, and this decision weakened the U.S. dollar and increased interest rates in the U.S., creating significant financial pressure. This is a high-risk financial strategy, as Japan is using its financial influence to directly affect the U.S. economy. Additionally, Japan is shifting its car production lines out of the U.S., with a significant portion of manufacturing moving to Mexico and Southeast Asia. This helps Japan minimize the impact of tariffs while still being able to supply products to the U.S. market. Without facing high tax rates, Japanese automakers like Toyota and Honda are heavily investing in manufacturing plants in Mexico and Southeast Asia, where labor costs are lower and unaffected by the protectionist tax policies from the U.S. This not only affects the U.S., but also makes international investors more cautious about purchasing U.S. bonds, especially as Japan is reducing its investment in this market future strategies. If the U.S. continues to make tougher decisions, Japan may escalate its retaliation measures. One possibility is to limit the export of core technologies, particularly solid-state batteries, which are leading the electric vehicle industry. Japan, with automakers like Toyota and Honda, is at the forefront of this technology. If the U.S. imposes tariffs on Japanese electric vehicle technologies, Japan might halt the export of solid-state batteries, which would significantly hinder the development of electric vehicles in the U.S., especially at a time when the U.S. is trying to boost electric vehicle production. Additionally, Japan could increase retaliatory tariffs on imported U.S. goods, directly impacting consumer products, machinery, electronic components, and even food cooperation with the EU and market diversification, while continuing to strengthen its cooperation with the U.S. Japan is actively expanding its trade relations with the European Union (EU). This will help Japan reduce its dependence on the U.S. market, while creating additional opportunities for its automotive industry to grow in other markets. The EU has signed trade agreements with Japan, helping to expand the market and mitigate the risks from the possibility of further U.S. tariff hikes. At the same time, Japan is increasing electric vehicle production in these markets to maintain its competitive edge. The EU is not only an important market for Japanese cars, but also a strategic partner in providing new electric vehicle technologies, ensuring that Japan is not left behind in the global trend. Will Japan be able to force the U.S. to change its tax policies, or will the U.S. continue to take a hard stance, causing widespread financial impacts? Stay with us to find out more in the next video. $390 billion pulled from U.S. bonds. This isn't a protest. Allied countries are preparing for the financial storm. And the reason Trump is back from Canada, China to Ireland, Norway, and even Japan, countries are rushing away from the U.S. dollar, as if they are preparing for a storm that's about to hit the main cause. Trump's re-election has increased concerns among international leaders about the return of the America First policy. This policy not only brings higher tariffs, but also expands financial sanctions, threatening global stability. As U.S. interest rates rise, U.S. government bonds are no longer as attractive as before, since the low yields fail to compensate for the increased risks. The instability in economic and trade policies, especially after the Russia-Ukraine war and U.S.-China tensions, has led countries to reassess their financial strategies. Not only are they reducing their dependence on the U.S. dollar, but many have also started to shift, seeking safer assets like gold, the euro, or even digital assets to protect their economies from increasingly unpredictable fluctuations. See the Allies' withdrawal wave in the last 3 months of 2024. It wasn't just one or two countries, but a whole range of nations that carried out a massive sell-off. Brazil pulled out $55.9 billion, Ireland reduced $42 billion, while the Cayman Islands and Canada also decreased by 41.9 billion, 2 billion and 37 billion respectively. India and Norway cut nearly 35 billion each, and even Japan and China reduced by 7.8 billion. This shows that countries no longer trust holding assets in U.S. bonds despite the stability of the U.S. dollar. And this raises the question, are these nations preparing for a major shift in their financial strategies? Trump triggers global trade retaliation. Many believe this event is no accident. The re-election of Donald Trump and his return to the political scene could be the trigger for this wave, the America First policy he implemented. During his first term with high tariffs and the use of economic sanctions caused concern among many countries. And now with his return, no one can be certain what will happen next. Trump has announced a series of new tariff measures with a reciprocal policy starting April 2, 2025, aimed at retaliating against countries with high tariffs on U.S. goods. This not only threatens traditional allies, but also increases uncertainty in international trade relations. Reaction of countries are responding strongly to. This move, the European Union (EU) has threatened to impose tariffs on iconic U.S. products, like motorcycles, whiskey, and jeans, reminiscent of the trade war of 2018 China. Not staying quiet has raised tariffs on U.S. agricultural products, particularly soybeans and pork. And it doesn't stop there. Canada has also started public consultations to address $125 billion worth of U.S. goods. These actions not only increase tensions between countries, but also create a chain reaction, causing global markets to face increased uncertainty. The future of international trade will depend on how these nations control and adjust their strategies in response to the strong protectionist policies from the U.S. impact on the U.S. and industries. The U.S. agricultural industry will face the risk of losing export markets as products like soybeans, corn, and pork could be affected by retaliatory tariffs. The U.S. automobile industry is not exempt either. The cost of parts will rise with car prices potentially increasing by $1,000 to $3,000, leading to decreased consumer demand and potential job losses in states like Michigan, Ohio, and Indiana, where the automobile industry plays a crucial role. Countries no longer believe that the U.S. is a safe haven for global finance. Will Trump's protectionist policies in his second term continue to cause major financial turmoil? Or will we witness a multipolar financial world where the U.S. is no longer the center? Stay tuned to the video to understand this issue. Is the U.S. supply chain collapsing? China's latest move is driving prices skyrocketing 20%. That's the shocking drop in U.S. imports. From China just last year, what does this mean? Will prices continue to soar? Could essential goods disappear from shelves? The truth is, America's supply chain is in serious crisis as China cuts exports and reduces its holdings of U.S. bonds. Let's dive in and uncover how this move is reshaping the global economy forever. China cuts investment in the U.S. What's happening? Here's the reality. The U.S. has been too dependent on China for decades. America benefited from low-cost imports from China, but now that economic order is collapsing as Beijing dramatically reduces its holdings of U.S. Treasury bonds. Why does this matter? Because Treasury bonds are a key source of funding for the U.S. government. If China cuts its investment, the U.S. will have to raise interest rates, borrow more, and face the risk of severe inflation. But that's not all. China is also tightening its grip on exports of critical materials. A move that could key U.S. industries is the global supply chain collapsing. Let's look at some industries hit the hardest: technology and electronics. Over 70% of consumer electronics in the U.S. come from China. If supply is cut, prices will skyrocket. Would you pay double for an iPhone? Automotive industry. Essential materials for EV batteries and auto components mostly come from China. If Beijing limits exports, the U.S. could face an electric vehicle supply crisis. Renewable energy. China controls over 90% of rare earth production, key for solar panels, wind turbines, and lithium batteries. If China restricts supply, America may fall behind in the clean energy race. And here's the real problem. U.S. companies can't quickly find alternative suppliers. Why? Because manufacturing costs in the US are significantly higher than in China. The result: consumers will pay the price. A study from the Peterson Institute for International Economics found that if this trend continues, the average American household could pay an additional $22,000 per year. Is the US dollar losing its power? It's not just the supply chain. The US dollar's dominance is also at risk. Consider this: China is increasing trade settlements in UN RMB with major partners like Russia, Brazil, and India. BRICS nations have begun reducing their reliance on the US dollar in global trade. The share of US dollar reserves worldwide has dropped from 71% in 1999 to just 58% in 2023. If this trend continues, the US could lose one of its biggest economic advantages, its ability to control global financial policies through the dollar. A major question arises: is this the beginning of the end for US dollar dominance? Can the US respond to this crisis? The US cannot afford to sit back. But the question is, what can it do to fight back? Some measures have been proposed. The CHIPS Act, a $52 billion investment to boost domestic semiconductor production. But is it enough? Experts estimate that it could take over a decade to build a self-sufficient supply chain, encouraging companies to relocate supply chains to friendlier nations like India and Mexico. But production costs will be significantly higher, increasing tariffs on Chinese goods. But this will only make prices rise even further for American consumers. So what's the real solution? Can the US quickly reduce its reliance on China, or is it already too late to change the game? The decisions made today will determine the future of the global economy. What do you think? Can the US turn this around? Stay tuned for the next developments. I'm driving the auto industry into a recession. GM shares are down 5%. We were sitting around the desk, looking at the declines in the automakers as President Trump is speaking. GM stock dropped 5%. Dow Jones lost over 540 points. The price of imported cars could increase by $4,000 to $10,000 with just one statement from Trump. Is the U.S. automotive market on the brink of recession? To make the 25% tariffs on car parts from Mexico and Canada could add between $4,000 and $10,000 in costs depending on the vehicle. No car is 100% made in USA. This is something most American consumers don't realize. Every car, even those produced in the U.S., relies on parts imported from Canada and Mexico. Therefore, when Trump imposed tariffs on imports from these two countries, the entire U.S. automotive industry has to bear the brunt, according to data from think tank Anderson Economic Group. The production cost of electric cars in the U.S. could rise from $3,500 to $12,000 per vehicle, depending on the type. An electric car produced in the U.S. could increase in price by up to $12,000, a hefty amount. And who pays the price for this? It's the American consumers who will bear the full burden of these rising costs. This will increase the cost of living for Americans. While the automotive industry is already in crisis, experts predict that the U.S. economy will continue to shake as stock values of automotive companies plummet, and the recession forecast becomes clearer than ever. President Trump announced 25% tariffs against our auto industry. And this is a direct attack, to be clear. A direct attack on the very workers that I stood in front of. The Unifor stood in front of. This morning, Canada, as a key trade partner, did not remain silent in the face of this tariff. Blow immediately spoke out, addressing the Ambassador Bridge, the iconic bridge connecting the U.S. and Canada. He strongly criticized the new tariff policy, calling it a direct attack on Canadian workers, and more importantly, he clearly stated the economic security and military cooperation between the U.S. and Canada. It's over. Canada decided not to stay silent, cutting reliance on the U.S., expanding global trade relations, and retaliating with tariffs that are multiple times stronger. This is a diplomatic slap without shouting, but one that gradually hits every citizen, every business, and the entire economy. Not only Canada, but Europe also could not remain silent in the face of this move. European Commission President Ursula von der Leyen condemned Trump's decision, calling it a stupid blow to the global supply chain, and not just Europe. Even Doug Ford, Premier of Ontario, to make sure we take a Team Canada approach to this. But I can tell you, we just aren't going to roll over. We're going to retaliate, and he's going to feel the pain from from the American people. This not only escalates tensions between countries, but also threatens the stability of the global supply chain, especially in the automotive industry. International markets are facing significant risks as political decisions directly impact prices.